In the pre-dawn hours on a Monday that would soon send tremors through financial markets from Wall Street to Mexico City, Mexican officials gathered to finalize what would become the most aggressive trade response in the country's modern history. The stakes couldn't have been higher. Just days earlier, the United States had imposed a sweeping 25% tariff on Mexican automotive imports, a move that threatened the livelihood of nearly 1 million Mexican workers and decades of carefully cultivated economic integration. What happened next caught Washington completely off guard, sending shockwaves through boardrooms across North America and leaving even seasoned trade analysts struggling to predict the fallout. The Mexican response came swift and calculated, targeting the most vulnerable points in America's automotive supply chain. Rather than a blanket retaliatory tariff, Mexico unveiled a surgical strike against critical auto components flowing northward, the very parts that American assembly plants can't function without. Within hours, export restrictions were placed on specialized wiring harnesses, electronic control units, and aluminum components that form the backbone of modern vehicle production. Simultaneously, Mexico announced substantial tariffs on finished vehicles imported from the United States, creating a two-pronged attack on the integrated automotive ecosystem that has defined North American manufacturing for decades. "We didn't anticipate this level of strategic precision," confided one U.S. trade representative who requested anonymity due to ongoing negotiations. "They've essentially identified the pressure points in our manufacturing system and applied targeted leverage rather than broad-based retaliation." Indeed, the Mexican response reflects a sophisticated understanding of the deeply intertwined nature of automotive production across North America, where components often cross borders multiple times before a vehicle reaches completion. Perhaps most concerning for U.S. policymakers was Mexico's announcement that it would begin aggressively pursuing alternative trading relationships for its crude oil exports. Mexican officials have already initiated talks with Canadian energy companies, while simultaneously exploring expanded relationships with Asian and European markets. This potential shift threatens to disrupt energy supply chains at a time when American refineries are already facing significant challenges. The Mexican government also implemented a series of non-tariff measures against U.S. companies operating within its borders, including intensified inspections, regulatory reviews, and administrative procedures that effectively create friction without technically violating trade agreements. For the American automotive industry, the impact was immediate and severe. Production planners at major manufacturers across the Midwest began emergency assessments of their supply chain vulnerabilities, with many discovering an uncomfortable truth: they simply couldn't build vehicles without Mexican-made components. Industry analysis suggests production costs could rise by $3,000 to $12,000 per vehicle if the situation persists, a devastating blow to profitability in an industry where margins are already razor-thin. With over 80% of Mexican-produced vehicles destined for American showrooms, U.S. dealers suddenly face the prospect of inventory shortages just as the summer selling season approaches. The electric vehicle segment faces particularly acute challenges. The massive industry-wide pivot toward EVs has created new dependencies on specialized components predominantly manufactured in northern Mexico. Battery management systems, high-voltage wiring assemblies, and thermal control units, all essential to modern electric vehicles, flow northward from Mexican facilities that have seen billions in investment over the past 5 years. The timing couldn't be worse for our electrification strategy, admitted one senior executive at a Detroit-based manufacturer. "We've committed to launching 3 new electric models this year, and suddenly we're scrambling to secure the components we need to make that happen." On factory floors across America's industrial heartland, uncertainty reigns. In Toledo, Ohio, assembly line worker James Hernandez described the mood as tense. "We've been told to prepare for possible production slowdowns if parts don't arrive. Nobody knows exactly what's coming next, but people are worried about reduced hours or even temporary layoffs if this drags on." Similar scenes are playing out in automotive communities across Michigan, Indiana, Kentucky, and Tennessee. where manufacturing towns have only recently recovered from pandemic-related disruptions. The economic implications extend far beyond the factory gate. Financial markets reacted swiftly, with the Mexican peso falling nearly 1% since April 2024 as currency traders priced in potential disruption to the country's export-driven economy. Meanwhile, stocks of major automotive manufacturers and suppliers experienced significant volatility as investors attempted to gauge exposure to the escalating trade tensions. Economists project declining U.S. imports as costs rise, creating inflationary pressure that could ripple through to American consumers already frustrated by rising prices. Industry analysts predict American residents may soon face higher prices, not just for vehicles but for a range of products caught in the crossfire of trade disputes. Perhaps most alarming for industry veterans is the potential for permanent structural damage to the automotive supply chain. The industry can probably handle these tariffs for a few weeks with minimal long-term damage, explained Michael Robertson, senior automotive analyst at Global View Research. But beyond that threshold, we'll start seeing suppliers make investment decisions that permanently alter production footprints. Some analysts predict potential closures among smaller auto parts suppliers unable to weather extended disruption, leading to job losses in both countries and potentially creating supply chain gaps that could take years to fill. Caught in the middle of this high-stakes trade confrontation is Canada, watching with growing concern as its continental trading partners engage in an escalating dispute. While Canadian officials have not implemented retaliatory measures of their own, they find themselves in an increasingly delicate position. Canada's automotive industry is just as integrated with American and Mexican production as they are with each other, noted Patricia Williams, professor of international trade at the University of Toronto. Any disruption to that ecosystem affects Canadian manufacturers, workers, and consumers as well. Intriguingly, Canada may find opportunity amid the chaos. Mexican officials have specifically mentioned Canada as a potential alternative market for crude oil exports, potentially benefiting Canadian refiners. Additionally, if trade tensions persist, some production might shift northward to Canadian facilities as manufacturers seek tariff-neutral ground. Canadian officials have carefully avoided taking sides publicly, while quietly positioning themselves as constructive intermediaries in resolving the dispute. The future remains highly uncertain, with industry experts mapping 3 potential scenarios. The most likely outcome, assigned a 70% probability by risk analysts, involves a quick resolution within 2 weeks, allowing both sides to save face while minimizing long-term damage. A second scenario, given 20% probability, envisions an extended disruption lasting 6 to 8 weeks, enough time to cause significant but not catastrophic supply chain disruption. Most concerning is the 10% possibility of what analysts are calling a tariff winter, a prolonged standoff lasting months and potentially forcing permanent reconfiguration of North American automotive production. Across the industry, companies aren't waiting to see which scenario unfolds. Major manufacturers have activated contingency planning teams, with some already exploring production relocation to minimize tariff impacts. Supplier executives describe working around the clock to identify alternative sourcing options, though many components simply can't be readily sourced outside established supply networks. We're looking at air freighting certain components from Asian facilities as a temporary measure, revealed one supply chain director. It's prohibitively expensive, but potentially less costly than shutting down assembly lines. For communities built around automotive manufacturing, the human stakes transcend balance sheets and trade statistics. In Aguascalientes, Mexico, where automotive production employs thousands, factory worker Elena Garza expressed frustration shared by many. The politicians make these decisions, but it's the workers who suffer the consequences. We just want to build cars and support our families. Similar sentiments echo across American automotive towns, where generations of workers have witnessed the industry's globalization firsthand, for better and worse. the dispute highlights deeper questions about North American economic integration. After decades of building increasingly complex cross-border supply chains under NAFTA and its successor agreement, the USMCA, both countries now find themselves wielding those very interdependencies as leverage. The irony isn't lost on veteran industry observers. The very success of continental integration has created mutual vulnerabilities that make trade conflicts increasingly costly for all involved. As negotiators work behind closed doors seeking resolution, the automotive industry holds its collective breath. The coming weeks will determine not just the immediate fate of vehicle production, but potentially shape the trajectory of North American manufacturing for years to come. Particularly for the electric vehicle transition, considered essential to America's industrial future and environmental goals, the stakes couldn't be higher. The bold moves by Mexico have demonstrated that the era of asymmetric trade relationships may be ending, replaced by a new reality where economic interdependence creates both opportunity and vulnerability for all parties involved. Whether this represents a temporary disruption or a fundamental reshaping of North American trade dynamics remains to be seen, but one thing is certain: the continental automotive industry will emerge from this crisis transformed, for better or worse.